Today, stocks are crashing and bonds are crashing at the exact same time. Your pizza is on fire and your salad is on fire. You are losing money everywhere you look. And to make matters worse, oil just hit $100 a barrel and inflation is eating your cash alive. Capital is fleeing the system. Smart money is running away from traditional investments and hiding in weird alternative strategies that most regular people have never even heard of. Today, we are going to expose exactly what is happening behind the scenes. We are going to show you why the herd is walking into a massive trap, and we will reveal the secret strategies that sophisticated investors use to make money when the entire world is panicking. To understand why you are losing money right now, you have to understand a man named Harry Markowitz. Back in 1952, Harry Markowitz was a young graduate student at the University of Chicago. He was reading a book on investing, and he realized that the old advice of simply picking good stocks was completely flawed. Markowitz invented something called modern portfolio theory. He proved with mathematics that you could reduce your risk by mixing different types of investments that do not move in the same direction. Imagine you own a business that sells sunglasses, and you also own a business that sells umbrellas. On sunny days, your umbrella business loses money, but your sunglasses business makes a fortune. On rainy days, your sunglasses business suffers, but your umbrellas sell out completely. No matter what the weather does, you survive. That is the core idea of diversification. Markowitz won a Nobel Prize for this idea. Wall Street took his math and created the ultimate financial product. They called it the 60-40 portfolio. The stocks were the sunglasses and the bonds were the umbrellas. When the economy was booming, stocks went up and made you rich. When the economy crashed, investors would get scared and run to the safety of government bonds. That would make bond prices go up and protect your wealth. For over 40 years, this strategy worked perfectly. It was the golden rule of investing. Financial advisors put millions of teachers and plumbers and doctors into this exact setup. But there is a hidden flaw in Harry Markowitz and his mathematical paradise. His formula assumed that stocks and bonds would always move in opposite directions. But what happens if the weather is not sunny or rainy? What happens if a massive hurricane hits and destroys both the umbrella stand and the sunglasses shop at the exact same time? That hurricane is called inflation. And that is exactly what is happening today. When inflation runs out of control, the entire financial system turns upside down. We are seeing a terrifying feedback loop taking over the global economy right now. And the absolute loudest alarm bell is the price of oil. Oil just breached the critical $100 level. To the average person, oil is just the stuff that makes gasoline expensive. But to an economist, oil is the master resource. It is the lifeblood of human civilization. Let us go back to 1973 to see what a true oil shock looks like. Back then, the Organization of Arab Petroleum Exporting Countries announced an oil embargo. They stopped shipping oil to the United States and other Western nations. The price of oil quadrupled almost overnight. The impact was absolutely devastating. People had to wait in lines for hours just to get a few gallons of gas. But the pain did not stop at the gas station. Oil is literally in everything. Oil is used to make the fertilizer that grows our food. Oil powers the massive cargo ships that bring electronics from across the ocean. Oil runs the trucks that deliver medicine to your local pharmacy. When the price of oil violently spikes, it acts like a massive tax on the entire global supply chain. This is the butterfly effect in economics. A war or a supply chain problem on the other side of the planet causes oil prices to surge. That surge increases the cost of manufacturing. The factories pass that cost onto the shipping companies. The shipping companies pass that cost onto the retail stores. And the retail stores pass that cost on to you. You end up paying 50% more for a loaf of bread. This is what we call broad inflationary pressure. It destroys corporate profit margins. Companies make less money, so their stock prices fall. At the same time, inflation destroys the purchasing power of the fixed interest payments you get from bonds. So investors dump their bonds and bond prices fall. The hurricane has arrived. The stocks and the bonds are both drowning in a sea of inflation. Your 60-40 portfolio is completely dead. This brings us to the most powerful and secretive institution on the planet, the Federal Reserve. The Federal Reserve is the central bank of the United States. They control the money supply and they control interest rates. They have what is called a dual mandate. By law, they are required to keep prices stable and keep employment high. But right now, they are trapped in a nightmare scenario called stagflation. Stagflation is an economic monster. It means the economy is stagnating and slowing down, while inflation is simultaneously exploding upward. Think of it like driving a car while slamming your foot on the gas pedal and the brake pedal at the exact same time. The engine screams and smokes, but the car barely moves forward until eventually the whole thing blows up. In the late 1970s, a man named Paul Volcker took over the Federal Reserve during a horrific period of stagflation. Volcker realized that inflation was a psychological disease. If people believe prices will go up forever, they will demand higher wages. If companies pay higher wages, they have to raise prices even more. It is a doom loop. Volcker had to break the psychology of the American consumer. He raised interest rates to almost 20%. He intentionally caused a massive recession. Millions of people lost their jobs. Farmers drove their tractors to Washington to protest. Builders mailed pieces of wood to the Federal Reserve because no one could afford to buy a house. Volcker took the pain because he knew it was the only way to kill the inflation monster. Today, the current Federal Reserve Chairman, Jerome Powell, is facing the exact same terrifying choice. Powell is about to give a highly anticipated speech at Harvard. The entire global financial system is holding its breath. Wall Street is desperate for a clue. Will Powell act like Paul Volcker and aggressively raise interest rates to crush inflation, even if it means destroying the stock market and causing a recession? Or will Powell surrender to the political pressure and let inflation run hot to save the economy from crashing? This extreme policy uncertainty is ripping the markets apart. When humans are faced with extreme uncertainty, our brains do something very dangerous. We panic and we follow the herd. To understand why investors lose all their money during a crisis, you have to understand the psychology of the human brain. A brilliant psychologist named Daniel Kahneman won a Nobel Prize for figuring this out. Kahneman discovered that human beings do not make rational financial decisions. Our brains are split into two different operating systems. System 1 is fast and emotional and automatic. It is the ancient survival brain. If you see a tiger jumping out of the bushes system, one takes over and makes you run away instantly. System 2 is slow and logical and calculating. System 2 is the part of your brain that solves complex math problems. When the stock market is slowly going up, over a period of 10 years, investors use System 2. They read financial reports, and they carefully balance their portfolios. But when inflation spikes and bonds crash and stocks plummet, System 1 takes over completely. The tiger has jumped out of the bushes. Investors feel literal physical pain when they lose money. So they panic. They look around to see what everyone else is doing. This is called herd bias. Right now, the herd sees that traditional investments are bleeding, but they see one asset skyrocketing: commodities. Headlines are screaming that oil is over $100. Everyone is talking about energy stocks breaking out to new highs. So the retail investors log into their brokerage accounts, and they blindly buy energy companies. They buy oil futures. They buy whatever is green on their screen. They are chasing past performance because System 1 is screaming at them to find safety. But the smart money views the world through a completely different lens. Sophisticated institutional investors are contrarians. They know that when a trade becomes too crowded, it is about to violently reverse. Let us look at how the greatest investors in history think. Sir John Templeton was a legendary investor who became a billionaire by doing the exact opposite of the herd. During the outbreak of World War II, Europe was falling apart. The mood was absolutely apocalyptic. Everyone was selling their stocks and hoarding cash. But Templeton borrowed $10,000, and he bought 100 shares of every single company on the New York Stock Exchange that was trading for less than $1. He famously said that the time of maximum pessimism is the best time to buy. He knew that the market had already priced in the end of the world. Any tiny piece of good news would make those stocks explode upward. Templeton made a fortune. Today, the contrarian investors are doing the exact same thing. They are looking at the herd rushing into oil and energy stocks. The contrarians know this is a first-order effect. It is the obvious trade. But the smart money plays chess, not checkers. They are looking at the second-order effects. If everyone piles into commodities, the trade becomes too heavy. If Jerome Powell steps up to the podium at Harvard and delivers a slightly softer speech than expected, the massive fear will vanish. The crowded oil trade will collapse in a violent reversal, punishing all the latecomers who bought at the absolute top. Meanwhile, the contrarians are already hunting in the wreckage. They are looking for deeply discounted companies that have been unfairly punished by the macro panic. They are looking for companies with massive cash flows and strong buyback programs. For example, there are bargain fintech, stocks that have been beaten down for 5 years. While the herd is staring at the oil price, the smart money is quietly accumulating these hidden gems. They are waiting for the sentiment to shift. But what if you do not want to pick individual stocks? What if you just want a strategy that protects your wealth? No matter what the Federal Reserve does, this is where capital is rapidly flowing right now. Sophisticated investors are moving billions of dollars into alternative investments. Specifically, they are pouring money into something called managed futures. To understand managed futures, we have to go back to 1983. A legendary commodities trader named Richard Dennis made a bet with his partner. Dennis believed that trading was not a magical genetic gift. He believed he could take ordinary people off the street and teach them a strict mathematical system to make millions of dollars. They ran an advertisement in the newspaper and hired a group of people, including a security guard and a professional blackjack player. Dennis called them the Turtles. He taught the Turtles a strategy called trend following. The philosophy is incredibly simple, but incredibly difficult to execute emotionally. Trend followers do not care about the Federal Reserve. They do not care about the price of oil. They do not watch the news at all. They only look at the pure mathematical price action of an asset. If an asset is going up, they buy it. If it is going down, they sell it short. They place hundreds of small bets across totally unrelated markets. They might be long on orange juice, futures, and short on Japanese yen and long on copper. Most of their trades lose money, but they cut their losses instantly. When they catch a massive global trend, they ride it for months or even years. They surf whatever wave the ocean provides. In a volatile stagflation environment, where stocks and bonds are crashing together, trend-following strategies absolutely thrive. They provide what Wall Street calls absolute return. They can make money whether the world is booming or burning. That is why the big institutions are adjusting their models today. They are abandoning the broken 60-40 portfolio, and they are carving out a dedicated allocation for managed futures. Another massive shift is happening in the world of hard assets. We are seeing institutional money hunting for niche commodity plays, like Chinese gold miners. Gold is the ultimate historical mirror. Whenever humanity loses faith in government paper money, they always run back to the shiny yellow metal. To understand the power of gold, you must understand the year 1971. That was the year President Richard Nixon completely severed the link between the United States dollar and gold. It was called the Nixon shock. Before that year, foreign governments could trade their dollars for physical gold from the United States Treasury, but the government was printing too many dollars to pay for the Vietnam War and social programs. The gold vault was emptying out. So Nixon went on television and temporarily suspended the convertibility of the dollar into gold. That temporary suspension became permanent. The entire world was suddenly operating on a fiat currency system. Fiat is a Latin word that basically means let it be done. The money only has value because the government says it has value. In a world where the Federal Reserve can print trillions of dollars with a single keystroke, hard assets become incredibly precious. But buying gold is not just about hoarding bars in a safe. Smart money looks for leverage. They look for mining companies that can multiply the gains of the metal itself. If gold goes up 10%, a well-managed mining company might go up 40%. It is a high-risk and high-reward strategy that requires surgical precision. So how do you actually survive this economic storm? You need a playbook. The first rule is survival mechanics. You must eliminate emotion from your investing. When the market is crashing, the worst thing you can do is aggressively try to catch a falling knife. You need a disciplined framework. One of the best strategies is dollar cost averaging. This means you invest a fixed amount of money at regular intervals, regardless of what the market is doing. But in a volatile regime, you have to modify this strategy. You cannot blindly average down into a broad index fund that is breaking structural support. You must only average down into high-conviction assets, where the fundamental story remains completely unchanged. You must use the 50% panic rule. If an investment falls by half, you must immediately stop buying. You must step back and brutally reevaluate your thesis. Has the world changed, or is the market just panicking? If the asset is truly broken, you must take the loss and move on. You must protect your capital at all costs. The second rule is tactical asset allocation. You might have a traditional defensive portfolio that is 55% stocks and 35% bonds and 10% cash. Right now, you need to trim the dead weight. You need to sell a few percent of your broad equities and a few percent of your bonds Take that capital and move it into the alternative strategies we discussed. Buy a tiny piece of a managed futures fund. Buy a small insurance position in gold on a massive red day. And most importantly, build up your cash reserves. Cash is not trash in a volatile market. Cash is financial ammunition. Cash gives you the psychological peace of mind to wait for the perfect opportunity. When everyone else is forced to sell their assets to cover their debts, you will be the one with dry powder ready to buy the absolute bottom.